Okay, this week, wow, the melt up continues. The It's been an incredible week, really. You're expecting, as a whether you're an investor or a trader, especially as a trader, you would be expecting some type of pullback in the market, and we just haven't seen it really. Anything worth note uh, since going back to October 27th, which was it? It's not really that long ago, but it's a month has passed. But the markets continue to go up, and there hasn't really been any pullback, and that's creating a lot of FOMO within the market because when the markets go up, you typically see some type of a retrace back, just kind of markets to catch their breath. But every time it's paused, just even intraday, the markets have continued up, and so we're in. The FOMO is setting in because people do fear on missing out on this, and I don't know when there will be a pullback where people can jump in, whether you're again a trader or investor. So you kind of, in some ways, you're stuck with what you have. You've got money on the sideline. You have to look at what's going on and see what you believe is going to happen. Now, in the previous episode, I shared some of the forecasts that David Hunter had put together on what they'll each of the indices potentially could top out at. But nothing's set in stone. So you have to make your own decisions about what's going on, and it's one of the things that I advocate for is people to take time to learn kind of the elements of trading, even if you're only an investor, because things are changing very quickly. And, old adages like, the market always goes up, I think are things that are going to be challenged here in the next few years. So let's just go ahead and take a look at these markets. Incredible. Today and yesterday, it just continued to climb. We'll look at some of the economic factors that drove it. But now, like I said, every time we've looked at maybe a pullback, we kind of expected it back on the 21st of November here. We had one maybe potentially going here on November 9th, and this is Dow Jones Industrial daily data. But every time there's been anything that remotely that looked like a pause, it got bought up immediately, and you can see what happened here the last couple of days. Just an incredible run up, and we are very close now to the all-time high of 36,952.78 in the Dow. You put these two days together here, and I think that would probably get you there. So if we have two more days like this, you're at all-time highs in the Dow Jones Industrial Average, which is it's really quite remarkable that we're seeing this melt up that David Hunter's been predicting for almost 2 years now, and probably would have expected it to have happened by now. But anyway, this has got some legs now, and the human psychology of investing and trading is going to start to play in if it hasn't already. Because those two candles those are big moves up, and it didn't exactly. I was kind of waiting for things to kind of peter out here at the end of today, and it never happened. So yeah, what is that? We'll do a quick measure here. Roughly, what is that? Less than 2% from the all-time high, or what is 600 points, 700 points, 707 points. Okay, the S&P. Again, the S&P 500 index. Here we sit at 4594, and the all-time high up here is 4818.62. So again, we're not far from the all-time high. We're hitting this peak that we hit back in July. We start to run through there, then it's going to get a lot of people's attention, and they'll start piling in because of FOMO, and continue to drive this thing up. I've seen this before. This has happened. I didn't know what was going on, but back in 99 2000 timeframe, you had this going on. I was in it, so I wasn't able to step back and see what was happening in these markets. But now with a little bit more knowledge, I plan to take advantage of what's happening here in the S&P 500. The NASDAQ, again, kind of came back a little bit the last couple of days. Was up a little bit today, but not a ton. And again, all-time high here is at 16,784. 784 points a day. It was up 53. I mean, you get a run like this from 14 to 16, you'll be well past the all-time high for the NASDAQ 100. I'll skip the Qs. Let's go to the Russell. And again, this is just daily data here. Excuse me. We ran up how many points today? 1805, 1862, 57 points, 53 points, excuse me. And, we're still very far from 24, and I'm, eons away from the 30,000 or 3,000 that David Hunter predicted. But you may, I wouldn't have suspected this would go up this fast. And it's moving. And we're getting back to this shoulder, probably back above it, that we had before. Kind of a rough looking inverted head and shoulders here. But a great run today. It needed it, the Russell. And with that, we've been talking about the breadth in the market, went up again, for the week. Take a look at it weekly. You can tell, again, we had a big run up a couple weeks ago. Not so much a big one here, but we're trending up. We're starting to get some breadth in the market, which a lot of people have been worried about. But typically, your leaders like the Apples and the Meta and Amazon and all those guys are the ones that tend to lead things up. And why is this happening? Well, we look at the Treasury yields, and these are weekly data again. So the Treasury yields have been heading down very steadily over the last few weeks, which takes some pressure off the markets. And the dollar, even though we had a run up last couple of days, I believe this week, you can see still finished down. Once we broke this level, I thought, okay, but it recovered it for now, but I'm still expecting this to break and then continue down. And I think ultimately the only forecast that I've seen on this is from David Hunter, which is around 80 here. Peter Schiff has been talking about it running down, but I don't think he's ever given any targets associated with it. Crude oil still continuing down. These are weekly data again. So these are all things that help the markets. And the VIX continues to crush down, struggling to get under this level here. This is a pretty solid level. I'm still expecting some type of correction at some point. I'm not, until I see it in the data, if I follow price action. So I'm staying invested. And then a put call ratio been crushed back down to 7 above 70 is, which is barely above right now, tends to be bearish. Below 0.7 tends to be bullish. So we're still a little bit on the bearish side there. But look at the progress. I mean, for a long time we were up in over the one figure, and now we're at 0.72 and been dropping. You can see we even dropped way down here at one point. Okay, my closing comments would be about gold and silver. So we'll come back to this chart a little bit later. Um, let's go to this week's data, and these are the things that kind of drove it. Although I think everybody was just looking for good news. You know, anything that will keep the Fed, to back off their raising rates. Now they may keep it up there for a while, but there different pressures are going to happen here as the market continues, the economic climate continues to deteriorate. So we're considering new home sales. 723,000 was expected. 697,000 was what we got. And if we just take a quick look, it may make this episode a little bit longer, but I think it's worth looking. We're slowly but surely, the environment is getting, from an economic standpoint, worse. Dallas Manufacturing Index, expected or forecast for minus 17, was down 19.9, which was worse than previous. Look, it's been ugly for quite a while, at least in the Dallas area. Home price, 0.2%, not much to really report there, pretty much in line. Consumer confidence actually came out a little bit stronger, but it didn't really seem to affect things on Tuesday. Wednesday, we see the 30-year mortgage rate down just a little bit to 7.37%. And the GDP really kind of, shocked things. But, my comment about the GDP growth rate is the government's responsible for 5.5% of it, with the spending that they have. And so the real growth is really, from a GDP standpoint, is 0.3%. The government's way too involved in this stuff. And so it doesn't allow the correction to come through that needs to happen in the environments. Between the Fed and our current spending that we seem to have become addicted to, this thing will blow up. I'm with Peter Schiff and David Hunter. This thing has to blow up. We just continue to manipulate things in order to make them appear good. And that's working so far. And when you're looking for votes as opposed to doing the right thing, that's what you're going to get. Thursday we had core PCE pretty much come in line with what the consensus was. We can see that it's steadily making its way down. Again, I think it's a bit of a mirage. Personal income was in line. And so everything was pretty much in line with that. And, the markets now are just looking for, fairly good news, on the inflation front. And that's enough to drive the markets up. The pending home sales, expected to be down 2%, was down 1.5%. Year over year, down 8.5%. And then today we had the manufacturing PMI came in weaker than expected. That's good from a Fed standpoint. And then Powell came out at Spelman College, I believe, and he took some questions and said, they just keep the rates higher for longer, but I don't believe, from what I've read, that he indicated that there's going to be more rate hikes. Things could change, but I'm not necessarily worried about that. And it was strange because the markets went down a little bit while he was speaking. The minute he finished, the markets headed straight back up, and leading to the candles that we saw earlier. Now, next week, what do we have? We have factory orders coming in on Monday. We have ISM services PMI. They're looking at 52. Will we see some more weakness here? JOLTS job openings, 9.35, which is less than the previous period. Expectation is to start to see this number come down. And it's not always in line with what's happening in the non-farm payrolls, which will be reported on Friday. But you know, expectation on Wednesday, we've seen the 10-year drop. My expectation is this may drop a little bit. Things could change between now and next Wednesday, but the only other thing are the initial jobless claims, which are reported every week, and then non-farm payrolls will be a market mover if something unusual happens. You know, if we continue to see a decrease in the number of jobs being created, then you know these are all things that people are looking for, you know, from a Fed standpoint. And then the Michigan consumer sentiment continues to slide lower. We just kind of look and see where you can see we've reached, you know, over 70% in July this year. Now we're down to 61.3, and I would expect that to continue to deteriorate. And you know, you're seeing things like people doing with a firm, which is a firm that allows you to buy something, but you don't have to pay right now. You maybe put a little bit down and then pay for it later, type of thing. So there's a lot of that stuff going on. Let's just take a quick look at the Fear and Greed Index, and it stands at 67. So people are getting greedy again, although I don't see a huge move in that way with regards to the markets, you know, from a standpoint of, you know, 67 is getting up there, but it's not something that I see with all the data and the put-call ratio that we looked at earlier. We see, let's look at the timeline, see what it looks like, and see we continue get up here around probably 82, 182 in the low 80s somewhere. Then I think you start to see maybe more pressure for a pullback at that point. But you'd think we'd get one with the way these markets have moved. So my final comment, I want to talk about gold and silver. I haven't talked about them that much. David Hunter has different targets associated with these and what they'll get to. But it's important, I think, for people to realize that this last week, and these are weekly data for spot gold, basically, you know, we had a breakout this week, and you know, this breakout now is something to pay attention to because we're looking at all-time highs. So we've never been as high as I believe. Not quite. We didn't maybe close. The close is the all-time high, but it's been higher intra-week, or in this case intra-day. Go back here and some of these dates, but this is the highest close looks like we've had for an all-time high. And what happens and why this is important is, gold has been manipulated, and yes, it does get manipulated there. And why can I say that? What's the evidence associated with it? Well, we know J.P. Morgan has been fined for manipulating the gold prices. So it's not something that's get rid of some of these Fibonacci's that I have up here. For manipulating, commodity prices, but not enough. They make more than they're fined, so they keep doing it. But it appears, because everybody was waiting for yesterday, since it was a month end, which just kind of looked like at the month end for November, it closed over 2,000. That's a big deal because it had never done that before on a monthly. So these are, significant things that are going on in the market, and the gold price, to me, being manipulated and taken down. Someone made the comparison of it's like a beach ball, and they keep pushing it down and down into, the pool, and gets lower and lower. Well, guess what happens when it it's unleashed, it explodes up. Now, I'm not making any investment things, but I do want people to be aware of some of the facts associated with gold. First of all, you couldn't even invest in it from 1933 to 1975. Most, I believe in the U.S. right now, investors hold 0.5% of gold in their portfolios on average. And most of those are people that are wealthy, but not everyone. And the average has been historically 1.5%. And some of the people that I've looked have suggested that are portfolio managers, again, not making recommendations, you have to do your own research on this, but that 5% of your portfolio should be in gold. Mine is much larger than that, personally, and again, not a recommendation, but just purely stating a fact, because I see gold going up because of this beach ball type of effect, pushing it down in the pool. I think this thing's going to explode up. David Hunter is calling for, well, originally he called for $2,500 gold, and then now he's calling, once this thing tops out, is at $3,000, and maybe even more, is kind of his expectation. So these are interesting times for commodities. Now, personally, I believe after we have the markets go back down, I don't know where we get 80% like Hunter saying, or Peter Schiff's saying basically the same thing. You're going to get big collapse in the markets. My expectation from everything I've read is that would happen. Only a Keynesian would say that no, things are going to work out really well, and that would be somebody like Paul Krugman. But my expectation is this thing's going to fall apart, and it's going to be pretty ugly. So you're going to get this meteoric rise. You're going to have a lot of FOMO, people jumping in, and whatever the hottest thing is. And gold is going to be I believe, is going to be the hottest thing here. As soon as it clears, I think people have talked about, my expectation would be it's getting institutional attention right now, but once it gets above 2,100 or so, then I think you're going to get the average investor trying to jump into this. Silver is kind of the same story. Now, it typically follows gold, and it's been making its climb back up, but and it has a tendency to move very quickly, but not last long. Now, these things are things that don't stay up there for months and months and months. They tend to go up and then immediately go back down. So the expectation, again, and just kind of, I'll put myself back on screen here. My expectation is that commodities will go up, as David Hunter and Peter Schiff has said. Where it tops out, not really sure. You at least got a target of 2,500 to 3,000 sometime next year. What it will make, at this rate, we could make it this year. But 2,500 to 3,000, let's say the first half of next year, might take a little bit longer. And these are just expectations. And then once we get the collapse in the markets, the commodities will go down also. They'll bottom out at, they won't be as badly hit as, let's say, equities would, but it'll still go down, maybe to levels that we had 2 or 3 months ago. Possibly down, let's say, here to 18 is kind of what I have outlined in my brain at the moment. So get this run up. Silver expected to go anywhere from, let me take a look here. What did they have for silver? David Hunter has, originally it was $50, and we stand at 25. And that's a important close there. And then, so going to 50, and then he changed it a little bit later to 60. So, these are, back to all-time highs again here and beyond, if they hit these levels before we have the collapse. And so I'm, securing my portfolio. I've studied miners from different people that are making suggestions about, you know, there's a lot involved in it. To know about miners, they're very volatile that are out there, as I've learned. Gotten a little bit burned on that, but at the same time, I apparently am not the only one. I'm a good company with Rick Rule and many others that study these things. And but I've learned a lot, and I've learned how to look at some of the miners to kind of ferret through what is a good investment and what isn't. And a lot of these could, we're talking about 5, 10, 15, 20, in some cases, people are talking about 100 times their investment. But again, they're very risky, So in order to do that, it has to be money that one would, from an educational standpoint, you'd be willing to lose. But when I started investing in it, was first of all gold, silver, platinum, palladium, uranium. Those are the things that I invested in. They're held at different places, and then in different warehouses, not necessarily in the U.S. And then once I had that in my portfolio, then I went to GDX and GDXJ are two indexes or ETFs that you can invest in that have combination. The GDX is typically the large miners, and then the GDXJ are the junior miners, which are even the more risky ones. And this is where you start to learn about whether they're run well, to whether they have good management, whether they have good the mines are capable of producing, how much they're holding. I mean, there's just a whole slew of things associated with it. But again, the base level is just owning the metal, itself. The only thing I don't advocate for GLD, because that's been the one that seems to get manipulated by the banks. So I've stayed away from that. I did originally invest in that, but now I've been in GDX and GDXJ, and then I own some smaller miners, some junior miners, and then I own most of the major ones that are out there, and there's not many. So when this thing goes and people start investing in it, it's like, it's like water coming through, and it's going to explode out through, or like I said, the beach ball example. Wow. Okay, that was a lot. Anything else I miss on this? No, I think I pretty well covered where I am, and hopefully provided you some value with regards to my closing comments here, something for you to research and look into. Anyway, that's what I wanted to cover this week. And remember, there is always a better way.